Welcome to Taking Stock for the week ending the 3rd of September 2021, where Jacob Simonsen, our Equities Analyst, and myself, Kien, Trinh, stream to you all things share market. Well, another month has ended, and August was a strong period for the share market, with the All Odds Accumulation Index rising 2.6%, and that was driven by strong performances in the tech stocks, healthcare, staples, and REITs as bond yields continued to decline. Remember, bond yields reflect future interest rates, and lower interest rates tend to favour growth stocks and companies with high debt like REITs. On the other end, resources all underperformed on the back of this correction in commodity prices, particularly with those iron ore stocks.
Yeah, and despite the strong market performance, our star growth stocks managed to outperform the market for the month and is now well above the All Ords over the last 6 months. Similarly, our star income stocks have also performed well over this period. We expect our star growth stocks to continue to perform well as we cycle through the severe rotation away from growth towards cyclical value. The focus will be on the long-term performance where our quality and growth factors really shine.
Yes, and with the reporting season now over, let's focus our attention to the corporate earnings trend for the year ahead. The chart on screen compares the All Odds Index, and that's in blue, to the market's 12-month forward earnings trend. As you can see, in recent weeks, the earnings upgrade cycle appears to have reached a peak, and that's courtesy of these statewide lockdowns that we're seeing across New South Wales and Victoria.
Yeah, that's right, Kien. And this is not a surprise because we have previously alluded to the market cycle, which has moved from expansion towards the slowdown phase. And during this period, we expect that easy gains, especially within the speculative stocks, to end, while high quality companies with strong cash flows and earnings growth should continue to thrive. The chart on screen compares the US economic cycle in blue and the rolling returns of the All Ordinaries Index in yellow. As you can see, there is strong correlation between the two. And what this means is that the share market returns are slowing down, but should remain positive for the year ahead. This is also consistent with the peak in the earnings upgrade cycle.
Yeah, and it's important now to revisit your portfolio so you can move towards those financially healthy businesses that can still generate capital gains through strong earnings and cash flows. And the end of the reporting season also allows us to re-evaluate our star growth stocks as we roll out our enhanced quantitative strategy. This model reflects the commitment we have for constant innovation to enhance our returns for the benefit of our members. In simple terms, the model ranks stocks on quality and growth factors that have proven to add value over time. But this process can only be completed once all companies have reported their financials. So over the next 2 weeks, you will begin to see numerous star stock changes between borderline star growth stocks and star growth stocks as we transition to this enhanced model. There will also be new star stocks to replace those we've removed in recent weeks. But we need to remind you that the star stock selection process is predominantly quant-based, so you will need to refer to our other golden rules, including the active risk assessment, management, sector exposure, and business description to ensure you are comfortable with the investment.
Yeah, and speaking about star stock removals, over the week we removed some iron ore and gold companies from our growth portfolios: Fortescue Metals, BHP, Mount Gibson, Northern Star and Regis Resources. The gold stocks, Northern Star and Regis Resources, reported large contractions in return on invested capital following a merger with Saracen Minerals and the acquisition of a 30% stake in the Tropicana gold mine. Meanwhile, we have removed Fortescue, BHP and Mount Gibson on the back of increasingly negative outlook on the iron ore price as China curbs steel output to reduce pollution, as well as expectations the world's largest iron miner, Vale in Brazil, will increase production next calendar year. We have retained Fortescue Re on BHP for income investors for now because we do believe that the surplus free cash flow generated over the last year should continue to support their attractive dividends, although the dividend expectations in FY22 may need to come down slightly to accommodate the expected decline in free cash flow.
Yeah, and another stock we removed this week was Platinum Asset Management. We've spoken about the heightened China regulatory risk to these fund managers for a few weeks now, and although its return on equity and net profit margins look high, the full year results was masked by profits from its seed investments, which comprises of emerging funds and other investment vehicles. Drilling into the core business though, the company's largest funds, the Platinum International Fund and also the Asian Fund, have underperformed their respective benchmarks over both the short and long term. And surprisingly, being a value fund manager, it was unable to capitalize on the growth to value rotation in the last financial year. And so this poor performance will inevitably weigh on its future fund flows, management fees and performance fees, making the 8% gross dividend yield on the stock look quite unsustainable. As a result, we see Platinum as a yield trap with limited growth potential.
Yeah, and another stock we've had to say goodbye to is IOOF Holdings, a wealth management group. Although the company is undergoing a major transformation following the acquisition of MLC Wealth, it was the inconsistent recognition of liabilities and cash flows from this acquisition which led to a deterioration in the financial health of the business. In other words, IOOF recognised MLC's liabilities in combination with only 1 month's worth of cash flow, and this led to elevated debt ratios like total liabilities to total tangible assets. Despite this, we do anticipate its financial health to improve at the first half 22 result once timing issues have been resolved.
Right, and a star stock removal which kind of raised eyebrows this week was Ramsay Health Care, a global hospital operator. Although earnings are expected to recover on the back of this vaccine rollout and hospital admissions for elective surgeries, the stock does not meet our growth criteria due to its slim net profit margins at only 3%. And this isn't enough to provide a buffer amidst state lockdowns, which has led to challenging operation conditions in Australia. And Australia now represents about 44% of the group's revenue.
Yeah, thanks for that, Kien. And look, turning our attention now to our calendar, following the reporting season, there are no star stocks reporting next week. However, a handful of star income stocks are going ex-dividend, including the likes of ASX, Fortescue Metals, Adairs, AUB Group, Accent Group, and Medibank. And for trend-sensitive investors, star stocks that turned bearish on the SD Max, that is the Stock Doctor moving average crossover, are Ansell, BHP, and Rio Tinto. On the other hand, those that have turned bullish on the SD Max include Infomedia and Nanosonics.
For Under the Microscope this week, we take a closer look at Australia's largest supermarket operator, Woolworths, especially following the divestment of its liquor and hotels business, Endeavour Group. Unfortunately, we've had to remove the stock from our growth universe because even though it generated strong growth in return on equity to 15.4%, its net profit margins remain under pressure due to higher investment in its supply chain and the COVID-related costs, such as fitting out stores to accommodate social distancing.
Yeah, and the demerger of Endeavour Group has allowed the company to conduct a 2 billion off-market share buyback from the excess capital. The ex-entitlement date was 2nd of September, with completion anticipated on the 18th of October 2021. Given part of the buyback will be funded by debt, it should lead to growth in return on equity in the coming year. Meanwhile, the gross dividend yield is expected to be circa 3.6%.
And many of our income investors, they are probably wondering how Woolworths compares to Coles. Over financial year 21, Woolworths performed better than Coles, although comparable sales growth for Woolworths has slowed down into the fourth quarter and early into the year, with the company reporting flat growth compared to 2% rise for Coles.
Yeah, so currently the sales momentum favours Coles, which also has a slightly higher gross dividend yield of about 5%. Both continue to benefit from COVID lockdowns and pantry stocking, which will help offset food price inflation and allow the company to sustain its dividend payments with strong free cash flow.
As we transition to our enhanced quantitative stock selection model, there will be numerous star stock changes and initiations over the next 2 weeks. So a few clients have been wondering, how can they keep abreast of all the star stock movements? Well, there are a few ways that you can do this on Stock Doctor. Firstly, you can turn on the Analyst email and daily digest notifications by clicking on your username in the top right-hand corner in the Stock Doctor and select Notification Settings. You will then be able to select which email notifications you would like to receive. Our Daily Digest email provides our Stock Doctor members daily updates on which star stocks are in and out.
That's right, Kien. And you can also access recent star stock outs from any 9 Golden Rules page by clicking on the Folders tab on the left-hand side of the screen. Select Stock Doctor Star Stocks and click on the subfolder Star Stock Outs 12 months. You can also access recent star stock outs from the Recent Updates tool by clicking Tools, selecting Recent Updates, and in the left navigation bar, selecting All Companies, the desired date range, and then make sure you select star stock recommendation changes and then hit the refresh button. If you'd like to know more about turning on notifications to keep on star stock changes, there's the help section in Stock Doctor, or alternatively, contact your relationship manager.
Okay, thanks, Jake. That's all we have time for today. But again, thanks for sharing your insights.
Thanks for having me on again, Kien.
So, with the market environment moving from expansion to slowdown phase, the easy gains have now been made. Hence, it's important for investors to reassess their portfolio, stick to those financially healthy businesses that continue to generate strong profits and cash flows, especially following the reporting season. Also, make sure you understand how to use Stock Doctor to monitor the star stock changes over the next few weeks as we transition to our enhanced quantitative strategy. Have a happy, healthy, and prosperous week, everyone.